let me know if and when you can see that. Okay. SS4, I'll deal with it later. Not right now. Sorry, I don't know how to fix that. Either, can you at least view the stream? Okay, cool. That's all that matters. Alright, for those of you who use moving averages, let's go ahead and actually drop this down. It's just the 200. You know what? Alright, so let's just know that purple here, or we can make them some more defining colors. What color can I see? Let's just do white. White for that one, and then our 200. Let's go ahead and make... I don't know, that one. Cool. Apply. Alright, so 200 EMA versus our 100 EMA. Don't worry about the rest of the lines. Coming up and tapping our 200 on the daily. We did wake up and test on, what was this? Friday. Yeah, okay. Friday came up, wick tested pretty much to the T. Didn't get through. We went ahead and pushed through on here. Back on Wednesday, we had jobs data, which we'll get into later this evening. That's going to be our education for the night, is jobs data itself. Jobs data came in a lot better than expected, giving us a nice pump, as well as Jay Powell speaking essentially to the market. He went ahead and confirmed the slowing of interest rate hikes moving forward, being that December is going to be a 50-point basis hike, almost guaranteed. So when we look at market implied expectations moving forward of interest rates, everything just shifted down a lot. Spreads on debt aren't quite as severe as they have been over the last 6 months. However, if they do come in and we get a hot inflation number again, and they smack it with another 75 from the expected 50, you know, we're really going to look to see a sharp drop off, you know, probably, you know, I mean, head back down to this 260 range probably within 2 to 3 days following, if they go ahead and do 75 basis points or more. Do I think they need to do that? Yeah. Are they? You know, who knows? It's the Fed. They're just trying to save face right now, so let's not fight them, and let's just kind of go with them. As far as standardized line technical analysis, there's not too much to really look at. You know, even if we just draw a horizontal across here, it doesn't really give us much to look at. So I'm not too centrically focused on technical analysis from that standpoint. However, we do get some sort of channeling pattern here. Let's see, can I get it? View draw, please. Thank you. We are starting to see some sort of channeling pattern here, wedge formation, looking to probably ping pong in and around here, bounce down. If we'll go ahead and don't need these anymore. And add the moving average weighted. Go ahead and apply that. We are well above that. This was a trade that was pretty evident with my strategy that I trade, if you were looking at it on the daily standpoint. So we are well above this on the daily stance, giving us indication that we are going to remain higher for longer based on that. However, it is also following the bottom trend of the wedge line here. So as this kind of shifts up as we go along over the next couple days into next week, we're going to try and look for something to break down. On a daily situation like this, you know, we're going to approach and probably teeter around it since it is wedging, and then go ahead and break down or back up. Not really sure at this point. it's going to be a confliction zone probably here on the 8th or the 9th, somewhere in here. If I had to guess, it'd be on the 8th rather than the 9th. So, stay tuned for that. Economic news. What economic news do we have this week? I believe if the Fed's speaking this week. Let me double check here. Sorry, 1 second. Nothing tomorrow. We do have the ECB. No, ECB is talking tomorrow. Okay, so that could be a little bit. We do have ISM services, factory orders, new orders placed, and ISM employment and core durable goods tomorrow. Have the 6-month auction coming up. We do have the U.S. API gasoline and crude oil coming in on Tuesday. God damn it. Wrong tab. Wednesday, what do we have? Anything important? We have consumer credit coming out on, and we have the Bank of Canada's interest rate decision coming out the 8th. Nothing really. We do have, oh, that's right, we do have PPI coming out on Friday. Okay, so PPI could be that day, like I was saying over here on the technical analysis side of things, on the 9th here, really kind of defining whether we break up or down. You can see that coming in and playing a big factor on there, but we'll see. So that's the QQQ. Over the SPY real quick. Pretty much the same story, really. Don't have too much technicals. And we do have a support, but we did break the support and broke back down, so this one's kind of weak here from a gap back in September. Back in May, a little bit. Not really much until we start tapping into this block here. So it's kind of just in free range right now. We did start to tap in to the bottom section of this volume block here. We have seen a former retest here that got rejected. We have seen the rejection come here. We'll see. Time's gonna tell on this and how we look at things. The main thing though is our macro indicators. Things are gonna be super volatile for a long time coming, at least for the next 18 months, I'd say. I mean, I know they've already been volatile for almost a year now, but don't expect that to kind of let up anytime soon. Keep it tight, be smart, be patient, take A+ setups. Home runs are great, but an extra $200-300 a week, that's great. On top of what your job's paying you already. So, if you don't have a job and you're making this, you're living what? I mean, it depends on where you need to live. $500 a month, or not a month, a week. Not too bad. There's worse situations to be in for a couple hours of your time a week. So, overall trends in the market, everything's pretty weak. We can take a look at crude. Whereas crude rejecting off of things, moving back down. We do have an expiration coming up. I don't think that's going to do too much. I do still have a small long position. I know I had I mentioned a long position that I had a while back in October. Exited that trade just about break even. I think I sold for a little bit higher than I entered. Didn't get quite the squeeze out of Russian oil issue that I expected. However, LNG, on the other hand, looking at Eurozone, moving forward, they're on pace to have the coldest winter they've seen in a very long time. Very cold temperatures. LNG supply is starting to dry up. What that means for Europe, I don't know. Greta Thunberg is still swinging her stick and hugging trees over there, so we'll see kind of how that plays out as everyone starts to freeze out this winter. So stay tuned for that one. Any other big macro news looking forward? Not too much. Everything's kind of been a waiting game and a standstill. The big thing though is jobs, the labor market. So the labor market right now holds the key to everything. Excuse me. So kind of looking behind the main headlines and macro data in the bigger picture can really make the difference in understanding where do we really stand in the entirety of the cycle here. So the last U.S. payroll report was tagged as very strong, but if you look deeper, you'll start to realize that the current state of the U.S. labor market is far from hot. Job creation is downtrending significantly. Alternative real-time and forward-looking labor market indicators point to a sharp deterioration ahead, and statistical inconsistencies are artificially boosting non-farm payrolls to the point the U.S. government's reaching out and be like, hey, can you kind of look at this? We need all the help that we can get. I know tons of people who are being asked on the macro side of the book to kind of help the U.S. government. Actually, it's quite funny. So don't take everything at face value, So when we look at the labor market, we're not technically in a recession yet due to the labor market, since job losses aren't here and nominal wages are still growing at a robust pace, but it's deteriorating fast, like I mentioned before. Its current state is far from very tight, which is definitions that we hear. We hear the loosening of the labor market and tight labor market, blah, 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 blah. But the Bureau of Labor Statistic and Non-Farm Payrolls released Friday their thorough assessment of jobs. So the NFP, which is our non-farm payrolls, I'm not going to say that every time, it's going to be called as the NFP, so remember that. Big expectations, we had a small net positive, revisions, and nominal wage growth surprisingly upside, which kind of made the market think, oh, this must be hot. I can agree that U.S. wage growth remains way too strong to achieve 2% inflation. Right now, it's rather consistent with 4 to 4.5% core CPI, where current wage growth is. So when we take that into consideration and we look at what the Fed's target is of the 2%, and U.S. wage growth remains at the strength that it's at, which would coincide with 4.5% CPI, what does that mean that the Fed has to do? They have to absolutely crush U.S. wage growth and U.S. jobs even more than it's really already doing. We'll get a little more into that here in a minute. It's important to remember, though, that nominal wages are the most lagging macro cycle indicator of them all. Most lagging out of every single thing. For them to drop, you need forward-looking growth down, activity down, companies cutting discretionary spending, consumption down, companies cutting CapEx, which is capital expenditure, and excess labor, activity down further, companies cutting core labor, and then finally you'll see nominal wages trending down as supply, demand, and the job market rebalances. So it takes a lot in the cycle for jobs to really come back. We could easily see 2 years of the markets absolutely ripping and rallying while the job market stays away. Actually, that's a good example. Let's go back and look at weekly on 20 years. So if we go back and look at 08, by the time we hit the bottom in 09 and it had ripped back up here through 010, we went from 67 to 1, so call it a double. We double the return in the stock market. Nobody was having a good time through here. People had lost jobs, people lost housing. No one really got back onto their feet until, call it 2011, 2012, somewhere in this time frame. But we'd already ripped from these bottoms. So a year and a half, 2 years ahead of by the time the job market went ahead and turned around. On top of the other data here, or at least the reason why they lag, the reason they would remain strong is that stubbornly low participation rate. And while it's true that less supply of labor coming back online means more wage bargaining power, it also means less people are actively contributing to economic growth. So the U.S. participation rate has actually started to head down considerably. We had our huge drop in 2020, and then we increased back up through there until now. We hit about the 67% retracement of 2019 levels, and now we're starting to head back down. And then again, when we look at the 6-month moving average and month-over-month average hourly earnings, they're just way too high to be consistent with 2% inflation. So they're going to have to take that down. But focusing on the momentum of job creation, where these jobs are actually created, tends to be more useful, forward-looking a more useful exercise than focusing on wages. So the 3-month moving average of the U.S. NFPs is clearly trending down. In November, the BLS reported most jobs were created in the leisure and hospitality, education, healthcare, and government. Accommodation and food services are still playing catch up with the pandemic disruptions, and job creation in the government/education sectors are not necessarily a sign of strong economic activity. The fact that economic sensitive sectors like retail, trade, transportation, manufacturing, and some areas temporarily of housing related jobs are all showing weakness is very telling. It's important to remember as well that housing makes up about 20% of our GDP. So when the housing market starts to go, it actually doesn't take long for all of that to really kick in. 20% of our GDP. Let's just say housing market goes into a total freeze, which it is in right now, or at least strongly leaning that way. How long does it take for 20% of those people to lose their job? Well, 20% of 20% of our GDP, that's 5%. That's 5% of our GDP workforce unemployed. So take that, add that in to our already existing unemployment rate. All of a sudden, we're at 6, 7, 8% unemployment, and jobs numbers don't look so good. But I think the elephant in the room, I don't know if you guys have studied or looked anything at the jobs numbers or macroeconomic data at all. But if you actually do go look at the BLS establishment survey and the NFP numbers, there's huge methodological and statistical issues that are really off in the data. So basically it's a household survey versus the BLS establishment report. A statistically significant survey requires a very large amount of respondents. The last NFP establishment survey got the lowest response, 49%, in 20 years. Now, that's okay, because we can benchmark the NFP survey with another regular job market gauge, which is the household survey. There's 3 main differences between the two surveys. The NFP survey asks businesses and government agencies about job creation. The household survey asks households. Multiple job holders are counted for each non-farm payroll in the NFP, while in the household survey for jobs, multiple job holders are counted only once. The NFP survey makes large use of statistical adjustments, so that's going to be like net business birth/death adjustment, while household survey doesn't. And according to the household survey, Literally almost zero net jobs have been created since March, against the 2.7 million that are reported by the NFP. Now, call me a conspiracy theorist, but I'd be willing to bet that actually no new jobs have been created since 2019. But that's another issue in and of itself. But like I just stated, statistical adjustments in the NFP survey, and they might have been very relevant in November given the low actual response rate. The BLS estimates how many new businesses have been created on a net basis and adds the resulting estimated net new job creation to the NFP numbers every month. And as recognized by the BLS itself, the pandemic has created disruptions, major disruptions at that, to their statistical methodology, which now keep showing an amount of new net business creation roughly double the pre-pandemic level. That might be a strong artificial boost to the NFP numbers and explain a lot of the difference with the much weaker household figures. I really don't think so. I think it's kind of discounted, and more so accounted for, and really something just kind of to discount at this point. So the challenge that was faced is, how do we get a cleaner reading of the real state of the U.S. job market? So a good gauge for that I found is the pace of full-time hirings, excluding multiple job hires. So on a rolling 6-month percent change basis, the momentum in U.S. full-time hiring is basically flat and in line with the weakest prints, example pandemic, of the last 10 years. Real-time alternative data can also be very helpful. For instance, LinkedIn. LinkedIn collects data on its members, so its users and its companies, adding new jobs to their profile, puts them into a hiring rating index, and does a bunch of stuff. Anyways, it shows the pace of U.S. hiring is down 20% or more from last year. That's insane. So how are so many jobs growing if the data is one skewed? We've already established that it's the bread's in the pudding there. But employers hiring is down 20% or more. How are so many new jobs being created if nobody's hiring, or at least hiring 20% lower, but our velocity of job creation remains higher? It doesn't make sense. So to me, it's weakening very fast. The question then becomes, it's the end of the year, so what does quarter one of 2023 look, and how do we kind of prepare portfolios for it? This isn't so much of the short-term trading side of things. This is more of a macro portfolio. But I do know some of you guys have IRAs, 401ks. You have parents, whatever. So might be good to know, to help them, because it is important. It's all going to come back to your day trading as well, whether you're net long, net short, high position, everything, your leap options, whatever. In either case, forward-looking indicators, are very useful in macro asset allocation because they tend to paint a good picture of what lies ahead for the main market drivers. That's going to be our growth, our inflation, and our central banks. The U.S. financial conditions, I tend to plot against the 1 year, or against the year-on-year non-farm payrolls. There's rapid changes that I don't know if I can do this on Thinkorswim.
From where did you get the data for the full-time?
Anyways,
full-time employees and stuff?
Point being, there's very rapid changes, and U.S. financial conditions lead job creation trends by 9 months. So why is one thing leading pretty much one for one 9 months ahead of the other thing? But because once equity valuations and borrowing costs deteriorate, or in other words, financial conditions tightening with our interest rates rising, companies first cut discretionary spending, then proceeds toward hiring freeze, and only later on do they start cutting labor. So it takes a few quarters for financial conditions, once they've tightened, to hit the labor market. However, if we look at jobs across the board, how many times have you guys seen in a headline within the last 2-3 months a big Fortune 500 company is laying off a couple thousand workers? You know, it's everywhere. It's not a secret. It's happening. But in either case, this indicator is leading everything by about 9 months. It is really what it's looking like. To me, it's not so much a matter of if, it's a matter of when. And my models that I run are pointing to 0 or negative job creation by late Q1 of 2023. So that's going to be a great birthday present for me. It means I got to position myself accordingly for my birthday in the markets. That's so much fun. I believe I talked about it a while ago. It may have been before this server was ever even created, back in the old server. But the economy in 2021 was a reflection of the massive monetary and fiscal easing in 2020. And the economy in 2023 is going to be the reflection of the massive monetary and fiscal tightening in 2022. And that line is proving itself to be 100% true. Looking forward in the markets, it's challenging, but it's like, if it walks like a duck, quacks like a duck, flies like it's a fucking duck, If it's a duck, it's a duck. You're not going to tell me it's not. So, if we should expect labor growth to gradually slow down to 0%, how do asset classes historically perform in this transition period towards a recession, which is kind of my base case for, call it Q2 of 2023. So, to really look at something like this, you need to go back to late 2000, early 2001. Probably the best historical parallels for the period ahead, followed close second by 08, late 07, early 08. In both cases, doesn't matter which one you look at. If you are going to go look and try and make the correlations and studies, please use 2000, 2001 before you use 07, 08 though. Either way, both situations, both time periods, equity indexes dropped an additional 10%, but defensive sectors, so it's going to be your utilities, consumer staples, and healthcare, held up a lot better. The U.S. dollar did well in 2001, despite the Fed cutting rates, while it underperformed in early 2008 as the housing market crisis unfolded. So, it's a 50-50 on that. Commodities and precious metals performance was mixed, kind of balanced. Government bonds delivered a meaningful positive performance for the portfolios in both cases. Actually, can I screenshot this? I can. Go ahead and drop this in chat. There you guys go. So that's how those kind of perform. Either case, my best case, or base case rather, is that the labor market will materially weaken and then lead us into a serious recession. We can have the debate of are we in a recession now? Are we not? I don't know. We pretty much are. We might as well be. We're just kicking that can. You know what? It's the United States economy. We just kick everything down the road until it's too late. Historically, recessions have always caused inflation to cyclically drop like a stone, and I don't think it's gonna be any different. I think inflation will drop like a rock in water. It's gonna happen, which will lead the Fed to cut rates aggressively in the second half of 2023 and bring them in the 2 to 3% area by early 2024, which gives us our proper pivot, but a Fed pivot, because of a bad recession, is not a bullish risk asset. It's kind of something to keep in mind. So like when that happens, when things pivot, it doesn't necessarily mean we get long. However, you can start positioning yourself. So when we look at the market today and what's going on, so actually let's just compare this. Where am I at now? There's our way. So stabilized drop off, run ups, drop off, run ups, drop off. So it's a thing that's happened before. It's not a big surprise. Can I wait a minute. Max. There we go. 2000s time period. Flatten out, drop back up a little bit, drop back up again, trying to meet that, back down, come back up, stabilize a little bit, hard drop off. It's not rocket science. That's just how it goes. You don't want to give me any data back past then. So let's go back to the daily. Let's just look at it now. Last year, we've had our flat tops. We've had our runs back up. We've had our drops. We've had our runs back up. We had our drop. We had our extended bull rally run in August, which was nice, followed by a drop. And now we're on a run back up. And we've been doing that actually since early October. At some point, we're going to drop back off. It's going to happen. It's just a matter of when. It's the end of the year. End of the year, everything kind of shuts down here in about a week. Not this Friday, but the following Friday. I know we at our firm, we're slowing down. It's the holidays, so not much is going to be going on. Trading slows down as a generality. It might honestly be a situation that happened exactly last year. We come back from the holidays, news gets printed, and off we go back down. I could see it kind of being a ping pong effect, really, until February, March time frame, that late quarter one, like I was talking about. Anything else to add to that? No, I don't think so. I think we're good. I covered everything I wanted to cover. So, any questions? Anything really? Just ask away. For some reason, my headset's not wanting to cooperate. So if you did just come off mute and are trying to talk to me, I can't hear you. You're gonna have to post it in chat. Unfortunately, I need to get another cable because this cable doesn't want to stop breaking. Ninja trading data. Let me go pull this up. So you can find a lot of information here. That's trading economics. That's the U.S. full-time employment. OECD as well. They have a lot of data on that as well. Or data. I think it's data.OECD. I just have a hot link. Let me. So I think I have. Sorry. I'm trying to pull up these links. There's that for you as well. That's from the OECD. Yep, no worries. As far as plotting things against each other, Fred is where you're going to come into play with that. Generally, or you could always do something really cool and get a Bloomberg terminal. That's always fun. And then you can start plotting your wildest dreams in that thing. Any other questions, comments, concerns? Something that you want me to recover, go back over again? If not, I'm going to go ahead and call it for the night and go eat. My food's been here for 45 minutes and I'm hungry and it's cold. But housing market in perspective. So housing market's, I wouldn't say a tricky one. Definitely too long to really dive into tonight, but we can definitely go over it a bit in detail. So, how do I want to explain this? All right, so all right, a bull case for the housing market ahead, and we're already seeing it if you pay attention to housing, is a total freeze. New marginal buyers are priced out due to the combination of today's prices and mortgage rates, and sellers will hold on for as long as they can to avoid hitting the lower bid on their planned sales. But that means plenty of pain for housing related jobs and or existing job creation. If we look at the financial markets, for example, investment bankers, if you actually look at an investment bank, tons of kids are getting laid off. There's no M&A work being done, there's no SPAC IPOs, no one's just pissing money. The Fed printer is turned off, so a lot of those kids are getting laid off. Same thing with housing, it's just taking a lot longer to happen. But the housing market, the math is simple for that. So given its demographics and labor force growth, the U.S. needs to add roughly 90,000 jobs per month to keep unemployment rates stable. Housing-related activity, so that's going to be our brokers, construction, furniture shops, etc., accounts for almost 20% of U.S. GDP and 12 million jobs. If all other sectors within the United States merely slow towards trend job creation and only 10% of the real estate related jobs are lost, U.S. non-farm payrolls instantly carry a negative sign to them and the housing market collapse. So it can get bad pretty quick, and I think it will. Unfortunately, the way I see things is the housing market is our next business cycle that we're going to see. We can look at the NAHB report, they have a housing index, and if you actually invert that and then compare that to the U.S. unemployment rate, it posts any unemployment rate sitting right around, I believe it was 7% in 2023. So, a vicious and powerful deterioration in the U.S. job market isn't the market consensus yet, but it's really, really, really starting to head that way. Again, with the jobs report that we just went over, here today. What's the trade on something like that? I mean, if you want to play sector specific, downside in home builders, it's going to be your REITs and credits linked to the real estate market. That's where you're going to look for that downside potential for gain there. Of course, if the housing market goes, the entire market goes though. So it's going to be like 2020, just reverse. You can throw money at anything, you're going to win. Correction. Where I think you'll see the difference is in energy yet again. Energy is going to be the standalone cap in all of this. energy is really going to do its own thing. I see no. I don't see energy correlating with anything else in the market for quite a while. It's just not going to happen until everybody wakes up. But that's besides the point. That answer your question, S4? Okay. Anyone else? Going once. Going twice. Sold. Alright, perfect. So I hope you guys all found some information, some of the information helpful. If not, sorry I wasted your time. And then there is a Google form that you can fill out as well. I know we're trying to get a lot of feedback from as many people as possible, so go ahead and leave a positive or negative review if you want. Doesn't hurt my feelings at all. It's totally fine. We'll just work on making things better. But other than that, I hope everyone has a great night, and we will see you all tomorrow or whenever Agent decides to stream again. Alright, cheers guys. Bye.